9 months ago, Wall Street was asking a brutal question. Is Amazon's AI spending a bet the company can actually win, or a $200 billion hole in the ground? On Thursday, Andy Jassy answered. Amazon's cloud division just posted its fastest growth in 18 quarters. Shares jumped nearly 9% after hours. And instead of pulling back, Amazon raised its spending forecast again to $220 billion. This is the story of a company that just proved the AI build-out isn't a gamble. It's a backlog. Let's ground this in numbers, not vibes, because this is one of those earnings reports that gets summarized in a headline and completely lost in the noise of daily market chatter. Amazon Web Services, the cloud computing arm that quietly generates the bulk of Amazon's operating profit, brought in $42.2 billion in revenue for the second quarter, ended June 30th. That's a 37% jump from a year earlier. Analysts polled by LSEG had modeled a little over 31% growth. Amazon didn't just beat the number, it blew past it by 6 full percentage points. And in a business this size, 6 points is not a rounding error, it's tens of billions of dollars of demand that Wall Street's models simply didn't see coming. Jassy called it plainly in the earnings statement, AWS is booming. It was, in his words, the unit's strongest growth in 18 quarters. You have to go back more than 4 years to find a comparable pace, and this wasn't a one-line boast. On the earnings call, Jassy laid out backlog figures that read like a company straining against its own ceiling, not one padding a story for investors. This is the part of the report that separates a genuine structural shift from a quarter of good luck. AWS's contract backlog, the total value of business customers have already signed up for but Amazon hasn't yet delivered, stood at $496 billion at quarter's end. 3 months earlier, that number was $364 billion. That's a jump of more than $130 billion in a single quarter. For context, that increase alone is larger than the entire annual revenue of most Fortune 500 companies. This is not demand Amazon is hoping shows up. It's demand that's already been contracted, sitting on the books, waiting for Amazon to build enough data center capacity to fulfill it. So when Jassy told investors, in a line that's since been repeated across every trading desk in New York, that even after this spending increase, Amazon still won't have enough capacity to meet the demand it's seeing in 2026 and that he expects the same shortfall in 2027, that's not a hedge. That's a company publicly admitting it is capacity constrained in the single most profitable business line it owns, with $496 billion of contracted work already lined up behind the wall. Here's where this story becomes bigger than one earnings call. It becomes a referendum on the entire AI infrastructure trade that's driven trillions of dollars of market value over the past 2 years. For 18 months, the bear case on big tech's AI spending has followed a simple script. These companies are pouring historic sums of capital into chips, data centers, and power infrastructure, and nobody can prove the revenue is actually there to justify it. Every earnings season, investors have braced for the moment the music stops, the quarter where a hyperscaler admits the spending has outrun the demand, and the stock gets punished for it. This was supposed to be a candidate for that moment. Instead, it became the opposite. Amazon raised its planned 2026 capital expenditures by $20 billion, pushing the total to roughly $220 billion, a 10% increase from its prior guidance. Most of that money is earmarked for the unglamorous, capital-intensive backbone of the AI economy: data centers, custom chips, networking gear, and the electrical infrastructure needed to actually power all of it. And Wall Street didn't punish the increase, it rewarded it. Amazon shares rose 3.9% during the regular trading session, then climbed roughly another 5 percentage points after hours once the earnings details came out, pushing the total after-hours pop to nearly 9%. In market terms, investors looked at a company saying, "We're going to spend $20 billion more than we told you 3 months ago," and instead of selling, they bought. That inversion, more spending treated as good news rather than bad, is the real headline here, and it only makes sense in light of that backlog number. Jassy gave one more detail that explains why the capital plan keeps climbing: the cost of memory chips. He said rising memory chip prices were a major factor pushing Amazon's capital spending forecast higher, meaning part of this isn't even about building more, it's about the physical components required to build the same footprint suddenly costing more. That's a supply chain signal worth watching well beyond Amazon, because if memory costs are squeezing the largest cloud buyer on Earth, every other AI infrastructure player is eating the same cost pressure. Amazon also disclosed, almost as an aside, that its AI and chip businesses, the custom silicon lines like Trainium alongside its broader AI services, have each individually crossed run rates of more than $25 billion annually. 2 years ago, that sentence would have described Amazon's entire advertising business. Now it's describing a side project inside AWS that's grown into its own multi-billion-dollar enterprise, almost overnight by corporate standards. Now, the part of this report that the celebratory headlines tend to skip, free cash flow. This is where the story gets more complicated, and where a viewer with a critical eye should slow down. Amazon's free cash flow turned sharply negative on a trailing 12-month basis. The company burned $7.6 billion over that period. Compare that to a year earlier, when Amazon generated $18.2 billion in free cash flow over the same trailing window. That's a swing of roughly $26 billion in the wrong direction. In plain English, the company that just posted blowout cloud growth is currently burning cash rather than generating it, because it's plowing essentially everything, and then some orch, back into infrastructure. This is not unique to Amazon. Microsoft, Alphabet, and Meta all reported similar drops in free cash flow this earnings season, as each ramps up its own AI infrastructure spending. It tells you this isn't an Amazon-specific story, it's an industry-wide capital cycle where the 4 largest technology companies in America are simultaneously deciding that negative free cash flow is an acceptable, even necessary, price to pay to avoid being the company left without enough compute when the AI boom fully matures. And crucially, Amazon wasn't alone in beating expectations this week. Both Microsoft and Alphabet also posted cloud revenue that comfortably cleared Wall Street's estimates in the same reporting window. That's the signal that matters more than any single company's number. 3 separate hyperscalers using 3 different accounting teams and 3 different analyst models, all independently surprised to the upside on cloud demand in the same quarter. When one company beats, that's a company story. When 3 do it simultaneously, that's a demand story. And demand stories are much harder to dismiss as one-off noise. So what do you actually have here, stripped of the noise? A company that spent 2 years being questioned about whether its AI bet made sense, answering with the 2 numbers that matter most in this argument: revenue growth accelerating to its fastest pace in over 4 years, and a contracted backlog that grew by more than $100 billion in a single quarter. Everything else, the capex increase, the cash burn, the memory chip costs, is the price of admission for capturing that backlog before a competitor does. Where does this go from here? Let's lay out 3 paths, because the next 12 to 18 months will determine whether Thursday's rally was the start of a durable re-rating or the peak of a hype cycle. The first path is the demand keeps outrunning the supply. In this path, Jassie's warning proves accurate and durable. AWS remains capacity constrained through 2026 and into 2027. The backlog keeps growing faster than Amazon can build data centers, and Amazon continues raising capital spending guidance at each subsequent earnings call. In this world, the negative free cash flow isn't a red flag. It's a preview of margin expansion still to come, because contracted revenue that hasn't been delivered yet becomes revenue that gets recognized later, once the infrastructure catches up. Under this scenario, expect Amazon's stock to keep climbing on results, even as headline cash flow numbers look worse, because sophisticated investors will be pricing the backlog, not the trailing cash statement. The second path is the spending outruns the return. This is the scenario the bears have been warning about since the start of the AI infrastructure race. In this path, the current backlog reflects front-loaded enthusiasm, companies locking in cloud capacity now out of fear of missing out, rather than durable long-term usage. If actual workloads don't scale to match the contracted backlog, Amazon could find itself sitting on enormous, expensive data center capacity with utilization rates that don't justify the spend. Free cash flow, already deeply negative, would stay negative for longer than investors are currently pricing in, and at some point the market's patience for trust the backlog narratives could snap, the way it has, historically, with prior infrastructure supercycles in telecom and fiber optics. The third path is the industry consolidates around the biggest spenders. In this middle path, Amazon, Microsoft, and Alphabet's simultaneous ability to absorb negative free cash flow becomes a competitive weapon rather than a warning sign. Smaller cloud providers and enterprises trying to build their own AI infrastructure simply can't match $200 billion annual capital budgets. Over time, this scenario sees compute demand consolidating even further into the 3 or 4 companies that can afford to run cash negative for multiple years at a stretch. Meaning today's spending isn't just about serving 2026 and 2027 demand. It's about making sure no credible competitor can catch up on infrastructure even if they wanted to. Realistically, the near-term evidence points toward the first path blending into the third. The synchronized beats across 3 hyperscalers in a single quarter is the strongest argument against the second path. It would be an extraordinary coincidence for 3 independent companies to simultaneously overestimate demand by this much in the same 3-month window. Here's my read on this, and I want to be direct about it. This earnings report is the closest thing we've gotten to hard evidence that the AI infrastructure spending race is not a bubble in the traditional sense, at least not yet. A bubble is defined by spending that outruns demand with no contracted revenue behind it. What Amazon disclosed on Thursday is close to the opposite. nearly $500 billion of backlog that customers have already signed up for, growing by over $100 billion in 3 months, with the CEO explicitly stating the company still can't build fast enough to keep up. That is not the profile of a company throwing money at a speculative trend. That's the profile of a company rationing capacity. Does that mean there's no risk here? No. The free cash flow swing, $26 billion worse than a year ago, is real. And if you're an investor, you should watch it closely over the next 2 to 3 quarters. Spending $220 billion is only a smart bet if the backlog converts into recognized revenue at a pace that justifies it. Rising memory chip costs are also worth tracking because if component costs keep climbing faster than efficiency gains, today's capital plan could look conservative a year from now, meaning more raises, more cash burn, and more scrutiny. But the headline conclusion stands. For the first time in this AI infrastructure cycle, a major hyperscaler didn't just claim demand was strong, it showed a contracted backlog large enough and growing fast enough to make that claim verifiable. That's the difference between a story and a balance sheet. If you've been trying to figure out whether this AI spending cycle is the real thing or the next .com-style overbuild, Thursday's numbers are as close to an answer as you're going to get this year. Watch what Microsoft and Alphabet do with their own capital guidance over the coming quarters. If they follow Amazon's lead and keep raising spending while backlogs keep growing, this stops being a company story entirely. It becomes the defining industrial build-out of the decade. Subscribe for the next report the moment these numbers move again, because at this pace, they will.